Now, in this segment, I want to talk to you about advanced special tactics. Sounds great. Sounds special forces, doesn't it? SWAT of trading. Before I do, I just want to remind you a couple of things. Don't forget shorting. We're not just talking about trading in one direction. Shorting is where you sell first, of course, and you might have sold at the higher price at 16,841, and you buy back when the price has fallen at the lower price. So you're just reversing the order in which you trade and make profits. Okay, and you can see that when we sold at 16,841 and then we bought back after the price dropped at 16,835, we made our pips and we made our profits. And here's an example that you can see. The other thing I wanted to, before we talk about special advanced tactics, to reinforce is just the risks. The biggest risk to scalping is you don't exit your losses, and therefore your losses keep on mounting. Remember I said that with some scalpers they'll add 3 times their losses to average down, but each time, in that case, once they've done all 3, they're only trading a third of their overall max risk, which will be 2% of their portfolio value. So a third of 2%, 2/3 therefore of 1% on every single position. Secondly, you don't trade with the trend breakout or with a pullback is a major risk. If you don't follow the strategies I've mentioned where you're trading with the trend, therefore you can capture a bit, or with a breakouts where there's more momentum anyway, or with a pullback, then of course you're in immense risk as well of just getting things wrong, basically, and ending up with a lot of losses. So let's turn on the advanced tactics then with those things in mind. One of the cleverest things we can do with trading is ensure that once we've got a view, we're not just sitting in front of the screen. I mentioned earlier pullbacks. One thing that I love to do is where I think a price will continue in the direction it's in. So for the chart that we're seeing on screen, I think it's going to continue downwards. But I also think any pullback where it goes up will be short-lived because the momentum is overall down. Maybe the fundamental news is also down. Remember we said we trade fundamentally, we execute technically as one of our 10 rules. What that means is we have an idea about the fundamentals. For instance, sterling dollar, I had a strong feel that it's going to go lower because all the news items were suggesting that the dollar is just going to keep on strengthening. Therefore, sterling is going to be weaker, and therefore the direction is going to be downwards. But we want to trade that technically, i.e. by looking at the charts. Any pullback, therefore, I felt where it starts showing strength and rising won't last. And because I don't want to keep watching it, what I would do in that situation is put in what's called a trailing entry. So what's a trailing entry? We are currently, the price is currently up here. You can see, I'm just going to mark where the price is on screen. That's where the price is at the moment. Now, a trailing entry, and this is an order entry screen, which looks very complicated initially, doesn't it? It would be this. First of all, we've got our symbol. Then it's a sell, because remember, we are expecting a fall downwards, so we sell. We sell the amount that we're comfortable with. Some brokers will therefore work out that how much you're going to make or lose for every pip. Okay, so what this is showing is just 100,000 lots in sterling dollar. And to me, I always get confused with things like lots. I think, well, 100,000 lots, what are they talking about? What does all that mean? This then calculates, okay, for every point it moves, 6.22 is what I'm going to make or lose. This tells me the current rate, 1.60718. That I want to enter, the current rate at which I'm willing to enter. That's not the rate at which it's trading, it's my entry. And you can see it here, it's marked on the screen. So what I'm saying is if the price pulls back to here, I want to enter short. Remember, because I'm selling, so I want to enter short. So if the price does move up to my entry, I'm saying I expect it to fall lower. Okay? I'm willing to put a stop loss in. I'm going to make it a trailing stop. In other words, it will track the price lower. And you can see the stop. It's over here. So it's been in place and it's shown. So that'll be where I'm wrong, and that it's not simply going to pull back and move lower, but it might actually have just reversed. So I'm happy to put a stop loss in there. And I've put a limit in. Limit is the point at which I'll take profits. I've put it all in pips. So all these numbers are in pips. And you can see the limit order. And as you can see, I'm scalping because I'm expecting if it falls lower, it'll at least go down to here, at least go down to my limit. So all done on screen. I then go away and go to sleep or something. You know, I don't need to be looking at it all the time because everything's been put on. You can see that's my entry and that's my limit at which I'll take profit because it's a short little bit of profit. That's my stop loss where I think if it goes there, then it's not a pullback. So what I'm expecting to happen is it goes from here down to here. Simple. That's called a trailing entry. Why is it a trailing entry and not just an entry? Well, because what I'll have set this at on a different screen, once I've created the order, is as a trailing. So as this price moves lower, all of these three things will track it accordingly. So at the moment, it's set at these levels, these specific distances from each other and from the entry price. As it moves lower, because it might not be that it just pulls up at this point that I'm looking now. It might be that it just continues lower and lower and lower and then pulls up and comes down. Whenever that happens and I don't want to keep watching it, that's when the order will execute without me having to watch it. And that's the trailing part. It trails the price without you having to watch it lower and lower. And all these positions, so the entry, the distance from the current market price, that will just trail lower, and the limit will trail lower, and the stop, they'll all be kept at the same distances and just move lower with the price until that trade is about to happen. And that's the beauty of trailing entries. And another advanced tactic that I like to use, where I don't know when the market will turn, but I don't want to keep watching it, I'll do a trailing stop. I'll summarize all of these tactics in a second, by the way, on a nice little chart. So what is this? Well, this is where, let's say I have entered the market and I don't know when it's going to turn. I'm in profit and I don't want to keep watching it. A trailing stop, a simple trailing stop. So you click stop and you say you want a trail, a dynamic trail, and that's your stop there. And so what will happen is as the price moves up, so the stop will just trail behind it. And as soon as you get a pull back, it'll exit. So what you're saying is that I know it's going to turn. And when it turns, all I'm saying is I want to get out. But I want it to keep on tracking this. I want the profit to run until that happens. So the reason you do this is because you think, you know, I don't know for how long it's going to keep going up and I don't want to keep watching it. And I don't want to exit right now. I don't want to set a target because it might go well beyond my target. What I will do instead is set a trailing stop because when it turns, I don't know what's going to happen. And it turns, it might turn lower and lower. It might resume back upwards. I'm not sure. So I'll just exit when it does turn because I can't be watching it all the time, and that's a trailing stop. The great thing about trailing stops is you can have a massive long trend and you don't have to watch it. It just keeps on moving with the trend and you can leave your desk and just get out when it's turned. And at special tactic number 3, or advanced tactic number 3, I call the smash and grab limit. What this is where I know if it falls a little, it will fall a lot more, but I don't want to keep watching it. So what does that mean? Well, it's where I say to myself, look, I'm going to have an entry, and you can see the price currently is sitting here. Okay, so let me mark where the price is. The price is currently sitting here. And I say to myself, right, you know what? If it falls down to this entry level here, which we've marked, you know, I've done then I think it's going to fall more. So I've done a sell, short. And what I've said is, I think if it falls down to here, that's when I want to go short, then it'll definitely go all the way down here. So all I'm saying with this, have I analyzed that? Well, my view is if it falls that far back, then I bet it's going to continue falling a bit further. And that's just a quick smash and grab. Just get it, get those points and get out. Now, you might say, well, Arbish, how do you know it's going to go down there? Doesn't matter. If it doesn't go there, fine, the order will never be executed. My point, and all I'm saying is that, you know, it's got out of this downward trend. It started to move up. Will this last? I don't know. But I know if it doesn't last and comes down a bit, then I bet it's going to fall a lot more. That's all I'm saying. Think about that. Think about what I've said. I'm going to say it again because it's quite advanced, actually, what I've said and how I've analyzed it. And these are the things that traders and scalpers often missed. There's a downward trend. It started moving up a bit. Is it going to continue in that direction or is it? I simply don't know. So what I do is say, well, actually, if it doesn't, and I'll know it doesn't if it hits this point, then I reckon if it does hit that point, it'll go lower. Now, you might say, well, Ambush, what if it doesn't? What if it hits that point and then goes back up again? So I try and pick an area where I've got a high probability that should it hit that, then this upward trend is definitely over. I try and pick an area low enough where I say, and if it goes that far down, there'll be enough momentum to carry it forward to the limit order. That's how I do it. Let's say I'm wrong, and the 20% of the time that I don't get it right, then I just will either have put a stop or I'll risk it on the basis that it will just add to an overall short position, which I'm happy to have for the longer term, because I think the longer term, so not the 5 minute, but the 1 day moves are still lower. So do you see how that works? Equally, let's say I end up with a short position where the market's still rising because it doesn't hit this limit, then all that short position will do is maybe reduce my overall long positions that I might have in the same currency. Remember, I'm talking about being able to hold simultaneous long and short positions with a broker. That's the kind of broker that we want, and they're very common. So there, where my limit isn't hit and I'm therefore holding a short position, it might just reduce my overall long exposure in the market. And I might say, well, I'm happy to do that. And that's why I haven't put a stop limit. I'm willing to leave the desk because, as I said, overall trend is down. There's an upward move. I don't know if it's going to last. And therefore, if it should hit this entry, I think it'll move lower and hit that limit. I often place these last thing at night. I wake up in the morning and quite a few of them have given me profits. One or two have just hedged out. I reduce my overall exposure in the opposite direction. Sometimes I'm left holding a short position I didn't necessarily want, but I think to myself, well, actually, the overall trend anyway, longer term, is short. So when do you enter these? Well, the circumstances are that you're not sure if a move upwards. We're talking about shorts. The same thing applies just in reverse to longs, of course. You just turn everything upside down to what I've said. But for this short, when do you enter these? You're not sure if any upward move is going to last. That's the key thing. You feel that if it does move to an entry point where the probabilities are such that it's not just daily volatility that takes it to this entry, and it's an art picking it. There's no exact science to picking it. You might try and pick support and resistance levels. That's fine. But on the whole, I work them out by sight and say, well, in my experience, so here it's a determined move. If it goes that low, it's not just daily volatility. And I think if it's going to go that low, then it's going to have resumed its original downward trend and therefore should hit the limit order and test the lows that we saw earlier. That to me is simple logic. When I look at a chart like that with you, it might take a bit of time to try and appreciate thinking like that, thinking like a trader, which is our starting position being, I don't know if this is going to continue in an upward motion, but if it doesn't, then I'll know because it'll get me into a trade only at that point. And most times these trade orders won't come about, and I'll just the next day just clear them because the trade might have just continued going upward and upwards, and that's fine. But I'm talking about this specific move. Right, advanced tactic number 4, smash through trailing stops. Now, another advanced tactic. If it falls below a certain level, then it will fall a lot more, but I don't want to keep watching. Then instead of just putting a limit order, I'll put a trailing stop. Okay, explain the difference between why on the last one I put a limit, where I said to myself, oh, it's gone upwards, and I think if it falls below a certain level, then it's going to go a lot more, but I don't know how much more. I also don't know if it's going to hit that level, so I only want an entry at that level. So what I've done here is I've done a sell. I've put in a rate at which I want to enter the market. So I'm not entering right now, remember. I'm entering here at this entry point where it says entry S, entry short. Okay, 160580. That's my entry short. So what I'm saying is if the price from here, and it's currently at this level, this is the level the price is at the moment. If this upward trend doesn't continue, and I don't know if it's going to or not, and instead falls all the way down here below this low, then I actually think it's going to go a lot lower, and therefore, but I don't know how much lower, so I don't want to limit my profits by putting a limit order in. I'm not going to put a limit order in because I don't know how much lower. I think it could go a lot lower. I think it could really break down. Therefore, I just put a trailing stop. And what the trailing stop does is it trails my entry, and if it moves 100 points lower, it'll trail it. If it moves 10 points lower, it'll trail it and get me out if it should reverse sufficiently. So how far away do you put the trailing stop? You put the trailing stop at a distance where it's not so far that you lose so much money, but it's not so close that the daily volatility could just hit it. And you can see here, the distance I've picked is, it'd be pretty rare for it just to get hit by volatility alone. And you could argue it's a little bit too tight, that stop, but again, it's an art. And sometimes you didn't kick yourself because you got stopped out. But then again, remember, these are all ones where you're not going to watch the screen. Because you're not watching it, you're going to place these orders and you're going to walk away. I'm going to show you some examples in a second where that's worked really well. And therefore, there is a price to pay. Because, of course, if you were just watching these all day long, then you wouldn't need to put entries or stops or any kind of orders. You just trade it off the market and make your decisions. So let's just recap this one again. What was I thinking in placing such a move? First thing I was thinking is I don't want to sit in front of the screen. It's been going on a downward trend. It's now bounced up. I don't know if that trend's going to continue upwards. And I reckon if it falls below this level, which is the low it recently reached, then it could go a lot lower, but I don't want to limit my profits by putting in a limit order. Instead, I want my profits to just continue going, but I'll put a stop in so I can grab some profits if it does fall low. Now, the worst case scenario with this is, of course, it goes down to this level and then bounces back and you get a small loss. Fine, you got a small loss. You got stopped out. And of course, it could still then revert back. Well, that's the danger of not being in front of the screen all the time. The benefit is, and I put some of these trades in overnight as well and go to sleep. I wake up in the morning and I've got a nice little profit in my account rather than being stopped out at a loss, which is a very nice feeling. So let's look at some examples in all of this. Okay, here's an example where I entered short all the way up here. I'll draw the line there. I entered short, went to sleep or went away or whatever, and I had a trailing stop which got me out. So why was the trailing stop so good? Well, imagine I didn't have the trailing stop and I was elsewhere. All these profits that I got from here would have been evaporated if I came back to the computer all the way here, and I would have thought to myself, oh, damn, it fell that much and I missed it all. And what if I did a limit order? Well, the problem with the limit order is, let's say I did a limit order here, I'd say, oh, damn, it just kept on falling. So do you see why to put a trailing stop sometimes where you think the market could fall quite a lot? You don't want to keep watching it, but you don't know how much it's going to fall. And it just takes the profit without emotion, and you're not even in front of the screen. And that's what I love about it. And okay, I didn't get out right at the bottom, but then again, who would? I let the computer take all the emotion, and it just got me out at that point. I can live with that. So you see why a trailing stop works really well in that scenario. Let's look at another example of everything we've discussed. This is where we had a massive fall, and what I did here with this trade is go short and put in a trailing stop, a very narrow trailing stop, on the basis that if the market then rebounds a bit, I'll get out, and that'll save me looking at it. Let's just recap some of these things. First of all, with these special tactics, you're not trying to predict the size of the move. You don't know the size of the move. Very often you don't know the direction. That's why you're putting in an entry order at a far different point than where the price currently is. Secondly, you don't need to keep watching. That's great. And you don't need to predict the timing of the move. Do you see with these entry orders, the clever thing that we are doing, the wonderfully clever thing that we're doing is we're not saying when it's going to happen. That's why it's an entry order. It's saying whenever the price hits that. I don't know when that'll be. We're not having to watch the market, and we're not saying how big a move it'll be. That's why the trailing stop comes in. So let's convert all these order types into our predictions. If we predict if it moves, it will move a little, then we'll do an entry order where we say, right, if it goes up to this point, I think it'll move a little. And we do a limit order, and we grab our profits. If we think if it moves, it'll move a lot, then we do an entry order with a trailing stop. So it can keep on moving, and the trail will just move higher and higher. If our prediction is it will move, but I don't know which direction it will move, we do what's called a one cancels other order and a limit. I.e., it will move, but I don't know which direction, but it will move a little. Now, one cancel or other order is simply this. It's an entry plus a limit to go long, and it's an entry plus a limit to go short. We pick our entry levels, just like we did before, at points where we think, right, here's a breakout if it goes above this, and so on. And a one cancel other is just an entry plus a limit to go long and an entry plus a limit to go short. And whichever one hits first cancels the other order. So if you go long first, it'll cancel going short. And most brokers will offer that in the kinds of screens you saw earlier as well. Now, similarly, if we think if it will move, but I don't know which direction, and if it does move, it'll move a lot, then we just do one cancels other with a trailing stop for both. So we'll do an entry and a trailing stop to go long and an entry and a trailing stop to go short. Now you're probably asking, wait a minute, Abish, how do I know where to put the entries? Well, like I said before, the entries are going to be areas where you say to yourself, if the price goes here, I think it's going to move more in that direction. It could be a breakout level. It could be below a support level or above a resistance level. That's how we do it. And you'll see more examples in the lectures as we go along. Okay, if our view is it will continue in this direction and any pullback will be short-lived, then we do a trailing entry with a trailing stop or a trailing entry with a limit corresponding to it. Now, it might sound all a bit complicated, but what this has is the wonderful benefits of not trying to predict the size of the move, don't need to keep watching the market, and don't need to predict the timing of the move. Once you get used to doing these, trust me, they're indispensable, they're invaluable. It means you're spending maybe maximum 30 minutes a day, where previously you might have been spending hours a day in front of a screen. Of course, it takes time to input the orders for each of the 5 securities. And you can place multiple orders. So you can say, right, at this level, if it does this on a security, you can do a whole day's worth of orders on a security and just leave it. There's brokers who will happily put in 50, 100 orders can be set, and some of them will get executed during the day. Some of them won't because the price won't touch it. But you're just working on the basis that if it does these moves, then that's what's going to happen. And you can walk away and leave it and experiment with it. And it's one of the great things about trading now with modern platforms. Well, wait a minute. What about being wrong? Remember, one thing that we'll have done when it comes to being wrong is we'll have set a stop loss very often, or a limit in any event, so we're quickly out of the market. We hold both long and short positions for different time frames. Remember what I said earlier. A short position, which we might get into and we didn't get exited out of, and it's now at a loss because the market's rising, will either hedge our pre-existing long position, so reduce our long exposure, or confirm and add to our longer term view, which is the market's going to fall lower anyway. So we don't have a problem with being wrong in that scenario. The thing you've got to remember is, therefore, you don't ever want to be holding a position without any stop in a direction which you don't think the market's going to go in longer term. So let's say we shorted the market and we didn't put a stop loss, and we walked away and left the screen, and we thought that the market's not going to go lower in the long term, so we don't really want to be holding short positions. Well, you don't leave that without a stop, because otherwise it could just keep rallying and rallying, and it's a very dangerous thing to do. We open new positions, as I said, to hedge against pre-existing positions. So if we're wrong, we're only reducing our overall long exposure. Now, these techniques, these very advanced specialist techniques, these are the ones where we really finesse and make money in the markets. That's where we really do it. That's where we really do it. Let's just go through this last part Again, okay, the entry, the limit, and the stop. Entry is where you're saying to yourself, if the price should hit this level, then I think something's going to happen. Depending on what you think is going to happen is how you put your limits and your stops. If you think, I think if it moves up to this level, it's going to continue moving upwards, but only a little bit, then you place a limit. If you think, I think if it hits this level, it's going to move upwards and could move a lot, because the overall daily trend, 1 hour trend, everything, and the fundamentals are in good nick, then you do a trailing stop, because you don't want to limit your profits. Equally, you might, even if you've done a limit, still put a stop in any event, because you're thinking, well, I think if it moves upwards, it's going to move up to the limit. However, I don't want to be ending with a long position. I don't want to end up with a position in loss while I'm leaving this market, so I'm going to put a stop in anyway over here. There's a lot to take in there. You'll want to listen to this lecture a few times, look at the screens, get a flavor for what I've said. And the best thing, of course, is to practice these things. Practice them yourselves with a small account and see how and when we use them. There'll be lots of examples as we go forward and lots of recapping as well.